everyone, welcome back to the show. Let's Talk Property. My name is Life. I'll be your host for the show. Today, I've got a very special guest by the name of Ekow. We're going to be talking everything finance regarding property space, okay? I would like to welcome you, Ekow. We're really thankful to have you on the show. Just before we go into any detail, just give me a background of what you do. What's your specialty in the field of finance towards property?
All right, thank you, Life. Thank you and your guests for having me on your
welcome.
show.
You're welcome.
So I'm a high net worth international banker working for one of the top private banks in the country.
Wow.
We specialize in banking, finance, forex, cash investments, focusing on development finance, commercial finance, and obviously residential property finance. So pretty much in a nutshell, we do a lot of property finance from our side.
Oh, wow, that's very amazing. Multiple disciplines. Actually, it must have taken you a long years to acquire those different disciplines. But I'm very pleased to have you here. So today, before we jump into anything, because there's always a problem of people wanting to get into property, but they're not really sure in terms of finance. How do they get, access to finance? They've got the idea, they want to construct, they've got the plan, but they don't have the finance or the capital, the know-how of how to get finance. So I really want us to help and be informative in that space, But the most important thing that I want to start with is when there's always a word of bond. Do you maybe want to give me a brief of what is a bond, so that people can understand what is a bond? And when people get a bond, what are they committing themselves into?
Okay. So in essence, a mortgage bond is a bond on a property. If you are looking at buying a primary residence, for example, where you'll be staying, or investment properties, you'll come to the financial institution, predominantly a bank, and they'll look at financing you with capital. It's very rare that individuals like yourself and I and many other individuals would have maybe R1 million just lying around to buy a property.
Exactly. Yeah.
So you'll come to the bank will assess your credit and your profile, and they'll look at the asset, which is the property itself, and then we'll obviously look at financing. The general terms that we would look at financing properties would anything from 20 years to 30 years at most. Obviously, the longer the term, the higher the interest rates.
That comes
Exactly.
in. Exactly.
That's correct.
I like the fact that you mentioned mortgage bond. You know, that word actually is very important before the word bond. But we'll detail that some other time. But for today, I just want you to also give an insight of, because most people, they become afraid. I don't know if I can put it that way. They become afraid. They really want to go to the bank, but they become afraid because they don't really know, actually, can I qualify for a bond? So just give me a background of who actually can apply for a bond.
Okay. So any individual can apply. So obviously you have to go to, the first thing you do is find a property you'd like. Okay. Once you sign an offer to purchase with yourself, who's the estate agent, you'll send it through to the bank. The bank will then obviously pre-assess the property, pre-assess the client, and the most important thing is pre-assessing the client. So by pre-assessing the client, you obviously have to look at the client's credit profile. Okay. The unfortunate thing is a lot of people don't know that you actually have to get credit in order to get a bond. So example is a bank wants to see a track record of your credit and your profile, just to ensure that you are able to manage debt. Debt could be a credit card, a cell phone account, and a retail store account like Edgar's. They just want to see that profile to see that you can manage.
Your commitment towards your debt. Actually, I've had a few times where you want to get a loan or something, they actually will tell. I remember when I started working, I wanted to apply for access. I wanted to buy a car, actually. And they said I didn't have any credit profile. So go and open an Edgar's account so that they can track that record. So basically, any individual at home listening right now can apply for a bond. But what is important is they need to create that track record.
That's correct.
So basically, respecting their debt at the current space where they are will give them a better chance of getting a bond.
100%. So it doesn't have to be a large amount. It can be a very small amount, 500, 1,000. As long as you can meet your monthly obligations and there's a track record for that, we'll be more than willing to look into financing you on a larger scale, whether it's a vehicle or property. But there's normally a misconception about putting money on property. We'll tell someone, no, I'd rather rent than buy a property. Just give an insight of what are the importance, or how will you motivate a person to actually buy a property rather than renting a property from financial point of view? Okay, so buying a property is quite essential. At the end of the day, technically you don't own the assets. It's owned by the bank until it's paid off, but the bank will give you the money to actually purchase the property. the importance of a property is you're not paying someone's rental income.
Exactly.
You'll actually be paying for property in the long run, which ultimately will gain in terms of capital gain. So if you buy a property, for example, for R1 million,
yeah.
in the next 5 to 10 years, depending on the area, the type of property, it will easily be worth 1.5 to 2 million. And by then, 5 to 10 years, you would have actually been paying back the installment. So, for example, after 5 to 10 years, let's just say 10 years, for example, you'd have paid half of that. So by paying half of that, you'd have 500,000 that you'd have paid off.
Exactly.
The property's worth, let's say, 1.5 in 5 to 10 years.
Yes.
And there's equity there of about R1 million, which you've got access to, which is yours in essence.
Wow.
Yeah.
Wow, very amazing. A lot of us didn't know that, but like I said, we're grateful to have you here. Continuing into the financial space, right? What are the, besides, having a good credit, managing your debt, what are the others, behavior that someone can always keep track of in order to avoid not to be a desirable person to have access to funding or a bond, or in that case?
I'd say save money. Before you commit to buying a property, save a bit of money.
Yeah.
Banks generally don't give you 100% finance.
Yeah,
There are those odd occasions where you're able to get 100% finance, but generally you have to put down a 10 to 20% deposit. There's also transfer costs, there's bond costs,
yes.
which would obviously come
Tax
into the picture, tax
whatever.
implications.
Yeah,
So it's important to save up a bit of money. There are those that are quite fortunate to get 100%. Some can get even more, 110%.
Yeah.
But it's always better to have that bit of extra liquidity just so that you can put towards the property. It also saves you on a month-to-month basis in terms of your installment.
No, great stuff.
And
yeah.
funny enough, we actually give better rates to people that are willing to commit and put some funds towards the property.
You see, as you're mentioning that, actually I just recalled something. I'll get a lot of calls of people like business people. Normally it's difficult to get 100% bond when coming to business, unlike individuals earning a salary. But remember, there's a bigger scale of people. People are looking for shelter. There are people who are like, for example, they don't really get a monthly salary. For example, entertainers, people in the entertainment space. Some of them are freelancers. They don't really have, a steady income. What's your advice towards them in order for them to acquire property, like your artists, for example?
Okay. So I'm happy you mentioned that. So
Yeah.
from a bank point of view, we look at risk. So from a
Okay.
credit risk point of view, it's quite easy to loan or give money to someone who's got a salary, they work for a preferred employer, and there's constant money coming in. It's very straightforward, vanilla. We just look at maybe, let's say you earn a few things. If you earn R1 million,
manage your debt and
exactly.
whatever.
So we look at a few things. But for business people, and let's say specifically artists, my advice to them would be rather pay yourself a salary. It doesn't have to be a lot. All you have to do is whatever money you come in your business, let's say you're freelancing, you have a business account, whatever comes there, pay yourself in your personal account
A
salary, a fixed amount. It can be a very small amount as long as it's consistent. We like seeing consistency.
Exactly.
It's very key. We don't want to see 1 month you're paying yourself 5,000, the next month 50,000, the next month 100,000, the next month 2,000. Would rather have you pay yourself
a certain average reflecting every month,
Exactly.
A lot of people who want to avoid paying themselves salary because you need to pay tax. There's tax implications when coming to that. So I think what you're saying is let's stop avoiding tax. Let's just pay ourselves salaries
100%.
so that we can be able to have that steady income so that we
Exactly.
can convince the bank to get a loan. I hope everyone is listening at home. It's very important key, actually, what you mentioned. Let's just avoid tax, But also, I want us to discuss, funding in terms of development. There are certain people that just don't want to buy for residential for themselves. They actually want to get into the development space, So what are the implications? What are the requirements? Who can qualify for funding in terms of development? When I mean development can be residential, can be a school, can be a commercial building. So what are the implications there? What are the requirements?
So from a development point of view, that's a bit technical. So you would have to look at balance sheets. You have to look at expertise. The skill set is quite important to understand that you can actually construct a building from bottom to top. You'll be able to get an occupancy for whether it's a long-term lease tenant or you're going to get multiple tenants, depending on the type, whether it's residential or retail. It's also important to know who your tenants are. It's quite important. And obviously, the longer the lease, the better it is for us to fund. We generally don't fund those over 20 years. We'll generally fund those things over 5 to 10 years at most.
5 to 10 years.
By funding it for 5 to 10 years, we put something called a residual. Most people know as a balloon payment.
Yeah.
Just so we can obviously have a look at the property again to ensure that the property itself, it's actually as it stands. That's number one, is quite key, and it's also key to now look at the tenants to ensure that the tenants have committed to the monthly obligations, and as well to see whether you sign new leases with the tenants, because generally on the commercial side, people don't sign very long leases.
Look, I like what you just said. You just said right now that you look at, your leases. So you'll find the person already has a lease. For example, someone wants to develop a shopping complex. Must he get an anchor tenant like your checkers to sign a lease before you can actually give funds to develop, or can he develop without having an anchor tenant or tenancies or lease signed, prior before applying, or must have the leases?
So generally we would look at a split of 60% pre-sales. When I say that, we would want you to get leases of anchor tenants, like you mentioned, like maybe your Edgars and so forth, your checkers and so forth. We want to have that up front, so there's some commitment from there. Then from there, obviously at some point the occupancy would happen, but you have to do a feasibility study around the mall.
A bit of analysis in terms
just to
of
understand
the market, what's happening.
Yeah.
And a lot of people, that you'll find someone having millions and millions sitting in their bank account. They rather go blindly and develop and put money into property without doing an analysis. Market analysis is very important, and most people don't do it. And it helps you to actually convince the bank to give you money. I always advise people that, do market analysis before you do anything. Okay, but in terms of getting a loan, obviously, there's no free lunch. At the end of the day. So what are the things that someone needs to think twice about before actually getting a loan?
From my side, I just think, do a bit of research before you jump into anything. Do a bit of research to understand what it is that you're getting yourself into. That's number one. Number two, negotiate. A lot of us tend not to negotiate with anything. So, for example, if I'm just using a typical example, if I come to you as an estate agent to buy a property and you sell it for 2 million, why can't I offer you 1.5? And then you go back to your seller and you actually try and negotiate. And let's say we come to a bargain of 1.7. Once we get that, and I send my application to the bank, and the bank tells me I'm getting prime, which is 7%, why can't I negotiate and say, look, why are you giving me 7%? Can I maybe put down 10% deposit, and then you give me 6.5? So it's a matter of just understanding, firstly, the market, and negotiation. We're very quick to accept anything that's given to us instead of negotiating, which is a very rare skill, but I think it's quite important to negotiate.
Wow, very fruitful conversation. Guys, it has been very fruitful. I hope everyone is listening. You're getting the information. You have your notebook at home. You're making notes. Look, at the end of the day, as much as we can give you information, but it's for your own due diligence to do a little bit of research. We're going to continue after the break with the conversation. Stay tuned. Stay there. Right, welcome back to the show, guys. We've been having a very fruitful conversation here with Ekow. We're talking everything finance today. I hope everyone is staying tuned. Ekow, there's something that, before we went to the ad, I wanted to talk about, because most people, they also get how can I put it? They get demotivated when they have to pay for 20 years or 30 years, So what are the advices in terms of, mortgage bond towards the term of payment, towards the bond? Is there any way you can pay it quicker? What are the advantages? Is there any way that you can stick to the plan, or what are your advices around that?
All right. So firstly, generally, like I said, it's 20 years. You don't have to necessarily commit to it for 20 years. If you want to pay it off quicker, you just have to give the bank 3 months notice, 90 days notice to pay it off quicker. But generally as well, what I would advise people is rather use your bond as an access facility or flexi bond, if I can put it to you in that way. So I want to use a typical example. If you buy a property for R1 million, you finance it over 20 years, let's say you're meant to pay 10,000 a month. Of that 10,000, you're paying initially about 7,000 to 8,000 of interest and about 2,000 on capital. So let's say on day one when the bond registers, let's say, for example, you win the lottery and you get 600,000, for example. You put that 600,000 into that bond. It will act as an access or flexi facility. So by putting that 600,000 into the bond, your capital would reduce to 400,000. Your installment will still stay the same at 10,000. Yes. So your monthly installment would be 10,000. However, the interest on that would rather swap. Exactly. So the interest will now move to, let's say, for example, 3,000, and then you're paying 7,000 towards the capital, which you save a lot, because at the end of the term of 20 years, you actually end up paying 2 to 3 times, depending on the rate that
That's
you get.
what I always tell people.
Yeah,
I'm like,
yeah.
guys, be careful of something.
Yeah.
The thing is, you said something very profound again, okay? That flexi thing. You know, most people don't understand it. Because today, you've bought a property for 2 million. 6 months down the line, Rafia Patela, you get like, you know, 150,000, you know, you can actually put it towards the bond. But when you approach the bank, when you have capital towards your bond, what do you call it? When you call the bank, what are you saying you're paying towards what? Because some people will pay, but it doesn't give that access to take the cash in and out. What do you call that term?
Okay, so you can just say you have you want an access or flexi facility. It's quite important for you to let the bank know, because what can also happen is once you put in that money and then it's capitalized. When you capitalize, that means you remove it away.
Yes.
Then you don't have any access. Some people don't have that knowledge or understanding.
Yes, flexi. You said it's flexi?
Flexi. So it's a flexi bond.
Okay, no, great stuff. So, you know, in the sphere of the bond, the mortgage bond and everything, you know, like I said, everyone wants to be in property, but they don't know the know-how of how do you get into, you know, loanable, you know, access and stuff. Tell me a little bit about joint bond, because sometimes you find that we're a family, okay? You're my brother, and we're both working. We want to buy property for our own family. So tell me a bit about the joint bond. How can two people approach to get a joint bond? You know, what are the factors they need to look at? You know, how can they get that?
So you can apply with anyone jointly, whether it's a family member, a friend, a wife, a husband. By doing a joint bond, we actually get higher facility depending on your earnings. So we look at your combined earnings, and by having a larger combined earnings, you can get more. My only risk to that is there's usually a bit of complications around who has to pay for what, because at the end of the day, all of that is going to be on your credit profile.
Is it split equally or it's split based on your income? No. So if the bond is 10,000 rand, okay, and then I'm earning 30,000, you're earning 20,000, are we going to split that 10,000 into half, or how does it work, the criteria?
So we only debit one person, and that's it.
But
the challenge with that is from your credit record.
Yeah.
If we get R1 million and we know it's 50-50, on the credit record, it will still say R1 million for you, R1 million for me.
Okay.
It will still say you pay 10,000, and it will still say I pay
10,000. Yeah.
So if I'm applying for something for myself later, it's going to show, but you already have that R1 million. They won't understand the concept around it's a 50-50 bond.
It's a 50-50 bond,
and
yeah.
And now for me to get something for myself, it's a bit more difficult, because they'll be like, okay, you already have R1 million. If you want another $1 million, you need to justify like your earnings to show that you can afford that as well.
No.
So there's a bit of a disadvantage, but the advantage is, I would say for couples, it's easier and it's better to get a bigger house. But from
as a couple, when things go wrong, then it's another problem, because you need to split and whatever. No, very interesting. So also over and above the fact that, you know, you can get a joint bond and then it's not split equally. I didn't know that, but now I know it. So what are your advices in terms of people who want to really get into property, in terms of like how can you advise a young man? There's a young man sitting in the township, wherever in the village. He has the know-how. He has that technical mind, you know. How can they approach them? Is there any funding for finances? Is there any sort of like grant and stuff like that towards in the financial institutions like the bank, where someone has an idea can come and be funded or whatever? What is the free lunch loophole there?
So from a property point of view, sorry to say, but financial institution, it's all about making money. We look at the bottom line. So it's very difficult for us to give grants. That I'll be very frank about. We make our money from fees and from margin.
Interest that you make over the mortgage bond.
Exactly.
Over
so
a lot of time.
Yeah, I would say start small.
Start small. Yeah.
There's nothing wrong with starting small. Getting something for 200,000 if you are able to get that, and then work from there. Yeah.
No, great stuff. So also over and above that, I just want you to give a word of advice or a wisdom. You know, at the end of the day, you are where you are because you had to go to school, learn everything, the tactic, get experience and all of that. Because sometimes people don't want to get into property as developers or acquiring property. You know, they also want to get into property from financial point of view. Today, as people are watching you at home, you are a role model for them. How can one become in your space, become a finance person into the property space?
I think it's simple. It's unfortunate. Well, it's fortunate and unfortunate. I was privileged enough to go to university. I was fortunate enough that as soon as I was done, I worked for one of the biggest private banks, and we got a lot of learning. So they invest a lot in our learning, our expertise, and so forth. So It's a bit of a tricky one, but I'll just say, you know what, just apply. It's easy. Apply to any financial institution. Once you get in there, you start from the bottom and you work your way up. You just have to work hard. That's the best advice I can give.
Amazing. The key word is you have to work hard.
Yeah.
You know, before we wrap up the show, there are two burning things that, you know, I've always wanted to understand how they work out. So in terms of how can people avoid liquidation of their property from financial point of view? Must they put a little bit, pay upfront, maybe 3 months, 6 months? How can they avoid liquidation? Because a lot of people are losing their property because now the financial institution want their money. And they don't care of how you feel, how you wake up, whether you lost your mother or you lost your job. If you can't meet your suspensive condition, they will take their property back and sell it for a certain amount just to recover. And it becomes a loss for the person. How can it be avoided? Can you terminate early? Can you sell it? Like, what are the advices to avoid liquidation?
So my advice is just communicate. If you know you're not able to meet your monthly obligations for your property, just go to your bank and say, look, this is where I stand.
Yeah.
Unfortunately, due to whatever circumstances,
yeah.
I need help. And obviously the bank would try the best to try and come to some form of plan.
Yeah.
If you're not obviously able to meet those
That
obligations,
plan, yeah.
then obviously they'll take it to pre-legal and they'll try and obviously
Look, it's a very sad story. It's a reality. You know, in the property management space, like your body corporate, you see a lot. A lot of properties get liquidated and all of that. And it's not a nice story. People lose their shelter, you know. But in terms of from finance point of view, we're living in pandemic. Obviously, there's an impact of COVID. What are the financial implications in terms of COVID? Is it a buyer's market? Is there access to loanable funds now? Or is it difficult? How has COVID impacted? Did it make it difficult or is it easier now?
So for some reason, I'm sure even in your space, you see properties actually selling quite fast. So people are taking advantage of this opportunity because, like you mentioned, some are not able to meet their monthly obligations. We've also had a lot of clients that do moratoriums. Moratoriums is when you come to us and you ask for some form of payment plan because of COVID. And we've restructured a lot of our property book. But at the same time, there are those clients that actually come to us and saying, look, guys, we've seen this opportunity, whether it's a retail mall, whether it's a block of flats or whatever it is, and we want to buy it. We'll obviously look at the assets and we look at the client's balance sheet. And then I think it's something that, you know, we've been doing quite often. But at this stage, like you mentioned, it's more of the buyer's market. So I actually had a conversation with a friend of mine just before I got here. And she was asking me around, you know, properties and Limpopo, and she wants to sell,
she wants
what's
to
happening.
Buy and sell.
And I just said, you know what, take your time. Don't rush in a pandemic like this. Rather hold on to that asset. Ride out for 6 months before you see what happens.
I'm actually glad that I'm hearing it from a financial person that it's a buyer's market. I always get calls and they'll say, like, is it a buyer's market or what? Obviously, as a real estate agent, I have to do my homework, due diligence, you know, consult from the financial institutions. But it's grateful that I'm hearing it from you guys. It's a buyer's market. You hear it from him. It was wonderful to have you on the show. I must say that I respect the disciplines that you're in, and they're very quite interesting. Keep up the good job. You can save the world. You can save individuals. You can add value to the tomorrow. It was great to have you on the show. Guys, like I said, let's talk property. It's all about property. Stay tuned until we meet again on the next episode. Cheers.